The financial market is the most precise system ever designed to punish human instinct, bar none. You think stock prices move because of economic data and earnings reports? In The Psychology of Finance, Tvede dropped a conclusion that made Wall Street look downright foolish. More than 70% of market price movement has nothing to do with fundamentals. What he was really tracking was the adrenaline level of every single person in the trading room. Your fear, greed, herd mentality, wishful thinking, every survival instinct hardwired into your DNA, turns into a penalty slip the moment you enter the market. Newton lost the equivalent of 20 million yuan. Two Nobel laureate economists saw their fund completely blown up and wiped out. Not because they weren't smart enough, but precisely because their smarts gave them a deadly illusion that they were exempt. This book was published back in the 1990s, yet it accurately predicted the psychological path of every major financial crisis since. From the Dutch tulip mania to the subprime tsunami, from retail investors piling into institutions trampling each other, the script has never been rewritten, not a single word. Have you ever thought about a strange phenomenon? The same company, with the same profit, same revenue, same management. Its stock can first jump 30% within a month, then drop 40%. If price really reflected value, how could value swing like a roller coaster? Tvede gives an answer in the book. Price has never been a reflection of value. Price is a real-time voting machine for emotions. He cites a set of data. Researchers tracked more than 100 years of U.S. stock market history, trying to find the correlation between stock price movements and changes in corporate earnings. The result was surprising. The correlation coefficient was far lower than most people's intuition would suggest. In other words, whether a company makes money is one thing. Whether its stock goes up is another. So what does stock price track? Tvede's answer is 5 words: the flow of attention. When everyone's attention pours in the same direction, price races that way. When attention withdraws, price collapses. And that has far less to do with how good the company actually is than you think. Think of the market as a dark theater. Normally, everyone sits and watches the show. But the moment someone yells, "Fire!" everyone stampedes toward the exit. No one stops to check if there's really a fire. The stampede isn't caused by the fire. It's caused by everyone believing that everyone else believes there's a fire. That's the real-life version of the reflexivity theory Tvede hammers home. Price movements in the market feed back into people's judgments of value. When it goes up, you think it must be worth that much. When it crashes, you think it was always garbage. Price is not a thermometer. Price is a match. It can light the fuse of greed or set off a panic. In short, the candlestick chart you're staring at is not a projection of a company's financials. It's the overlapping waveform of millions of human heartbeats. So here's the question. Since everyone knows emotions mess with judgment, why can almost no one stay truly calm when it matters most? Tvede spends a lot of time on one thing. Your brain hardware was not designed for financial markets. The human nervous system was largely fixed about 200,000 years ago. Back then, your ancestors faced a simple decision. You hear a rustle in the bushes, run or not. If you don't run, you might get eaten. If you run, you waste a little energy. So natural selection favored a brain that says, better to run 1,000 times for no reason than miss running once. Move that system into the stock market, and you've got a disaster. Tvede draws on prospect theory from Kahneman and Tversky, revealing a pattern that has made countless traders wince. Humans feel losses about twice as intensely as gains. The thrill of making $10,000 is nothing compared to the pain of losing 10,000. What does that mean? It means you'll sell your winning stocks too early because you're afraid of letting paper profits slip away. And you'll hold on to your losers because you can't admit you made a bad call. Small gains, big losses. That's not a character flaw. That's your evolutionary factory setting, welded shut. Tvede gives a powerful behavioral experiment. Researchers presented 2 groups with choices. Group 1, take a sure 3,000 or gamble with an 80% chance of getting 4,000. Most chose the sure 3,000. Group 2, lose a sure 3,000 or gamble with an 80% chance of losing 4,000. Most chose to gamble. See what's happening? With gains, everyone's a conservative. With losses, everyone's a gambler. Put those 2 curves together, and you get the retail investor's eternal fate. Cut profits short, let losses run. You think you're doing rational analysis, but your amygdala has already hijacked your prefrontal cortex. Every hesitation to cut a loss, every impulse to chase a rally. It's a jungle hunter from 200,000 years ago pressing the trading button for you. But if it were just individual irrationality, that would be one thing. What's truly deadly is this. When millions of irrational brains connect, something emerges that's crazier than any single person. Tvede did something ambitious. He lined up every major financial bubble, from the 17th century Dutch tulip mania to Japan's bubble economy in the late 20th century, and found one fact. Their scripts were exactly identical. Every bubble has 4 acts. Act 1, stealth. A small group spots a real new trend. Early internet, early real estate development, some early technology. Prices rise gently. Participants are mostly insiders. The public has no clue. Act 2, awareness. Prices start getting media attention. Stories spread. My neighbor Wang made 3 times his money flipping houses. My co-worker bought some coin and is up 10x. Notice, the most dangerous thing at this stage isn't the price itself. It's the contagion of narrative. The human brain is far more receptive to stories than to data. One vivid get-rich story is more convincing than a 100-page risk report. Act 3, mania. Everyone is talking about it. Your taxi driver recommends stocks. The lady